My company is considering to invest in either Banyan Tree or hotel properties. How is the financial performance of these two companies?
To begin with, both hotel properties and Banyan Tree sees an increase in total assets from 2013 to 2015. Banyan Tree shows a more significant increase due to more development of properties. Secondly, for liabilities, both companies sees an increasing trend. Banyan Tree having a larger increase would mean they have more debts to pay off. Thirdly, for equity, the increasing trend for hotel properties was due to more investors investing in the company, whereas for Banyan Tree, the decrease in 2015 was due to the bomb blast, which caused the investors to pull out from their company. Next would be revenue. The decreasing trend of hotel properties shows that they are losing money along the years. However, the decrease and increased trend for Banyan Tree shows how they managed to recover the revenue in 2015, which was lost through a bomb blast in 2014. Lastly, with more properties launched for Banyan Tree in 2015, there was a need for more marketing activities which resulted in an increase in costs and expenses. As hotel properties only introduced one new property, the only costs and expenses needed was to refurbish the older properties, hence the decreasing trend.
How about the effectiveness of management?
For accounts receivable turnover rate, hotel properties is more efficient in collecting their accounts receivables than Banyan Tree, as they have a higher turnover rate which is favorable from a cash flow standpoint. Moving on to accounts payable turnover rate. Hotel properties is more efficient in fulfilling its accounts payables than Banyan Tree. A higher ratio means that hotel properties would have higher negotiating power in the future. So for cash conversion cycle, hotel properties is able to maintain at a negative rate, which means that it is healthy. Therefore, hotel properties is efficient in utilizing short-term assets and liabilities to generate cash for the company.
What about the efficiency of the use of long-term assets?
The total asset turnover ratio demonstrates an increasing trend for Banyan Tree and a declining trend for hotel properties. The figures illustrate that Banyan Tree is more efficient in utilizing its assets to generate sales. The fixed asset turnover ratio demonstrates a rather stagnant situation for both companies. Banyan has a fluctuating trend, whereas hotel properties declined initially but stagnated for 2014 and 2015. However, when comparing the results, the figures demonstrate that Banyan Tree is performing better than hotel properties in utilizing its fixed assets to generate sales. Now, moving on. The results on return on total assets demonstrate that both companies are facing a declining trend. However, when comparing both companies, hotel properties fares better than Banyan Tree in its ability to use its assets to generate income.
Tell me about the liquidity and solvency of the two companies.
For current ratio in both the case of Banyan Tree and hotel properties, there is an increasing trend from 2013 to 2015. However, when we compare the two companies, Banyan Tree has an advantage with a much higher current ratio than that of the hotel properties, showing that their liquidity is higher. For acid test ratio, Banyan Tree has the overall advantage at 1.24 compared to the 1.14 of hotel properties. However, hotel properties show a higher rate of increase and thus might increase by a larger margin in the future if they manage to maintain the current rate. Now we talk about working capital. Both companies show a positive change over the 3 years. However, Banyan Tree also showed a larger increase as compared to hotel properties, giving them the edge in this comparison. Now we look at solvency of the companies. Hotel properties is more effective in managing their liabilities as less than half their asset is made of liabilities. Moving on to the equity ratio in comparison, hotel properties is more effective in managing their equity where it is likely to attract investors with a higher equity ratio. Debt to equity ratio. Hotel properties is more financially stable with a lower debt to equity ratio as there is more equity over liabilities for the company. Next, for time interest earned. In comparison, hotel properties is more effective in managing their interest expense and meet their debt obligation with a higher time interest earned ratio.
What about the gross profit margin and other insights?
Banyan Tree is effectively producing and selling their products with a higher gross profit margin, putting them in an ideal position. Next, for net profit margin, hotel property is more effective in managing their expenses, which resulted in a higher net profit where they are more financially stable and sustainable in the long run. Moving on to returns on equity, hotel property is more effective in using money from shareholders to generate profit and grow the business. Lastly, for free cash flow, hotel company have a higher free cash flow, which means they have excess money to grow the business and pay their creditors in the long run, which put them in a healthy position.
After analyzing, Banyan Tree is doing better in the short term. However, this may not be ideal as investors and suppliers may lose confidence and trust in the company due to possible incapability to meet debt obligations in the long run. On the other hand, hotel properties will perform better in the long run in terms of profitability and solvency. The analysis portrays healthy financial position, hence being able to attract investors with their stable financial situation. So in order to ensure long-term benefits, the company should consider investing in hotel properties.